Okay, I got the recording started. Here we go. Yeah, we do. Sorry to say, or to repeat myself, a lot of people come to optionslam.com because they heard about this great strategy called the straddle, which you can just buy the straddle, and it doesn't matter if the stock goes up or down, you can win money either way. And at earnings, stocks move. Okay. So you come to optionslam.com and they got all these statistics about straddles and that, and like I said, that is true. We do have a lot of statistics about straddles, and we're going to look at some of those statistics today. We're going to look at actually trading the long straddle as a through the earnings release trade. In other words, you put the trade on right before the earnings, and with the intention of seeing a big move in the underlying stock. Whether it be up or down doesn't matter as long as it's a big move. That straddle has the potential to have theoretically unlimited profit potential. So all sounds great, but the odds are stacked against you. There will be more losers than winners, and occasionally a winner will be a huge winner. So it is possible to be a successful long straddle player. I got to tell you a quick story before we get into this. There was a time, and this is going back a lot of years, when I actively pursued long straddles as a through the earnings trade, and I was really good at it. I amassed a profit in about an 8-month period of time of over 300% against my risk. Okay, I worked a system, and between being good at the system and controlling risk and locking in profits and managing the trades and a lot of really good luck, okay, couldn't have done it without good luck. I amassed a 300% profit against risk. But on the 9th month, I lost 200. I lost 2/3 of that profit. In 1 month, I lost 2/3 of that profit with the same strategy. And I quit. I gave up. I stopped doing it. I never went back. So I walked away a winner. It's a short, true story. And I ended up a winner. It was great. But most people aren't that lucky. But let me try to clue you in on some of the things that can improve your odds in that strategy. And there are some stocks that you might want to consider playing that strategy at. So let's get on with the webinar here. And let's see if we can get through it. I don't think I can get through everything today. We already got, now this is the same PowerPoint slide. Let's get through the preliminaries here. Read and understand the CFTC rule before you risk your hard-earned money in the markets. Read and understand the CFTC rule. And know that we are not licensed advisors. We do not provide investment or financial advice or make investment recommendations. These webinars and all the information that you see in these webinars and all the trade examples are for educational purposes only. And I am Marco, and this is my email address. Love to hear from you. Please shoot me an email with your comments or questions. And I'm going to go through the first slides really quickly because we covered these in the last. I'm going to breeze through these. What is a straddle? Buy an at the money put, buy an at the money call. And then you have a long straddle. And there's pre-earnings trades. There's three, I think of it as 3 types of earnings trades. Pre-earnings, those are trades that you put on way before the earnings with the intention of taking them, well, not way before, sometime before the earnings event, with the intention of taking that trade off, closing that trade prior to the earnings event. Then there is the most popular type. When you hear most people talk about earnings trades, they're talking about what I call through the earnings release trades. These are trades that you put on right before the earnings is announced, with the intention of holding right through that earnings announcement and living through the IV crush. And then there's the post-earnings trades where you wait until after the earnings to initiate the trade. The long straddle as a through the earnings trade, that's what we're going to talk about. What is attractive about the long straddle? It's a defined risk trade. It has unlimited, theoretically, reward potential in either direction. What are the downsides? It does have a low probability of profit. The likelihood of profit in a long straddle is low, actually. Buying straddles, so is the opposite true? Selling straddles has a high probability of profit? Yes, but the other thing that's opposite about selling straddles is that they have unlimited potential for losses. So that's a very scary trade, right? Unlimited potential for losses in selling a straddle, unlimited potential for gains in buying a straddle. Unlimited risk in selling a straddle, unlimited potential for profit in buying a straddle. Okay, so that's the yin and the yang of the straddles. Options are priced to perfection. The number one enemy. So this is stuff we went through last week. Is the number one enemy of the straddle is IV crush, and then I put out the supposition that maybe the number two enemy is the IV build. And I guess the reason I said that is that because IV is building in your option premium, those options are getting more and more expensive as you approach that earnings date. So when you finally buy that straddle right before the earnings are announced, you're buying the highest implied volatility. You're paying the most for that straddle in terms of volatility. You're paying the most, not necessarily the most in terms of premium, but you don't know what strikes to choose unless you wait until that last minute before the earnings event to get the at the money straddle. You can't predict what's going to be the at the money straddle a week or two before. Anyway, so here we go. Which options to buy? Well, the at the money strikes. Which expiration cycle? This is an important question. We're gonna look at this a little closer today. The shortest duration are going to be buying, because you're buying options. So you're buying premium. So the less time you buy, the less money you're putting out there. Therefore, the less money there is at risk. However, when buying a straddle, to buy a little bit more time, surprisingly, doesn't always cost all that much more. We'll try to look at that as well today. Shortest duration, expiration cycle, the front week weekly, the options that expire this coming Friday, or the Friday immediately after the earnings event, or some longer duration contracts that go out further in time. That's the question. There's pros and cons. Weeklies versus monthlies. We all know there's many times, not always, but many times, there's more strikes available in the weeklies than there are in the monthlies. However, the monthlies oftentimes, most of the time, are more liquid than weekly options. There's more open interest. There's more daily volume. there are less strikes available sometimes. Longer dated options provide more options. What? Are you double talking me here, Marco? No, all I'm trying to say is short dated options leave little room for adjustments. Not only is there no premium left, okay, let's put on a long straddle that expires this coming Friday. And then you want to make some kind of adjustment, whether it's a winning trade or a losing trade. You can adjust both. We're going to look at some adjustments today. But if there's only 1 day left, or 2 days left, or 3 days left, if it's Tuesday, like today, and there's only Wednesday, Thursday, Friday, and the options expire, guess what? That IV crush decimated all premium in all strikes. Decimated premium. There's no premium left to sell against your long options. Whereas if you would have bought options that expire out to the next regular monthly expiration, something 2, 3, 4, or 5 weeks away, whatever the case may be, then there is time. Yes, those options also were affected by IV crush. Yes, it's true. They were also affected by IV crush, but not as bad as those front week weeklies that are expiring in just a couple of days. And now there's some time, there's still some premium left, and there's some room to move and make adjustments, whether those adjustments are to help enhance profits or reduce the amount of money at risk to minimize the losses. Okay? Longer dated options provide for adjustments to enhance profits or to reduce risk. Monthly options offer higher liquidity. Monthly options often offer less available strikes. These are all my talking points that I just went over, just put into print now. Further dated options cost more, so there is more money at risk. So we need to find a balance that we're comfortable with between how much money we're risking versus how flexible we will be with our position. Okay, we got to find that balance. Which stocks to buy straddles on? New issues, stocks that have a history of moving big, stocks with a news catalyst, and that could be meme stocks. Okay, the new thing nowadays is the meme stocks, the Reddit crowd, the Wall Street bets. Okay, that in itself, meme stocks, that in itself, I would consider a catalyst. If the Wall Street bets boys and girls are on it, that stock has potential of moving on an earnings event. That's a perfect, high short interest stocks, high short interest stocks. That's one thing I didn't put in here, but I should have. Stocks with high short interest can move big on earnings events with the help of the Wall Street bets crowd. That's what they go after, right? It's those high short interest stocks like GameStop and AMC, Bed Bath & Beyond, etc., right? But bottom line, ultimately, stocks that you believe have a chance of a big move, that's where you need to be. Test your strategy. I always say that, right? And use the Option Slam stock screener to find candidates. We're going to do that right now. I'm going to show you some examples of how you can use the stock screener to find candidates. These are the things we're going to look at. Tracking price change is the section of the screener that we're going to look at. And let's go do that right now. So what we do is come to optionslam.com, and we go to the earnings tab. We go to the stock screener. Open that up. I'm going to start with my generic screen. I'll just review what's in that generic screen right now. That generic screener is looking out 1 week from today. It's looking at stocks with weekly options. So for long straddles, you don't have to stick with stocks with weekly options. I like to stick with stocks with weekly options because then there's more flexibility, because there's more expiration cycles to work with. But if you're buying straddles, or for that matter, selling straddles, you're dealing with at-the-money options. And if you're doing it right before an earnings event, you're dealing with very liquid at-the-money strikes. Those strikes are in play, even on less liquid stocks. So you're going to get filled pretty good at midpoint prices with straddles right before an earnings event. The thing you got to be careful of is afterwards, are you going to be able to get out of the trade at fair prices? Are you going to be able to adjust the trade at fair prices? Or are you going to find yourself between a rock and a hard place? Okay, so that's the thing to be careful with, be aware of, okay? Those less liquid stocks. You can get filled on some pretty obscure stocks with at-the-money straddles with midpoint pricing. It's pretty surprising. I told you I got 9 months of experience of doing it regularly. It was years ago, but it's still pretty fresh in this old man's memory. All right, so let's see. I've got this set to $20 and up. I don't have an EVR here. We're going to talk about some of these other filters. I've got it set to a minimum average daily volume of 2 million. Again, you could probably not be quite that strict to get filled on straddle trading. You can, in fact, for sure you don't need to. I'm a promoter of trading liquid stocks, and the liquidity is very important. Okay, but on the other hand, you can find stocks that only trade 500,000 average shares per day and get filled on a straddle right before the earnings event at midpoint pricing. It's adjusting that trade and getting out of that trade later at midpoint pricing is where you're going to have a problem. Okay. So that's it. I don't have any of these other filters. We went through a few weeks ago this section. We went through this a few weeks ago, this section, mean and median calculations based on the last 4, 8, 12. We don't need this for at-the-money straddles. We don't need that. But what we are going to concentrate on today for this section of today's webinar is this section right here. This is where you can find and run some filters to find stocks that are good for straddles, whether it be short straddles or long straddles. This is the section that you can use these filters. So, tracking price change 1 day after the earnings release. So this is limited. We're only looking 1 day after the earnings release here. Okay. We're only looking at 1 day, the price change 1 day post earnings. However, as you know, you can go to any stock specific pages and go to the post earnings page to learn whether that stock continued that move, faded that move, what happened in the subsequent days and weeks and even months post earnings, post the earnings event. Okay. But for filtering purposes, we are limited here by just the 1 day feature here. So let's look at what did my screening without doing anything else, what did we get here? And by looking out only this week, we only got a return of 4 stocks. So right away, we're earnings season is a little ways off. It's coming up. So just to get a bigger sample size, I'm going to extend this out to 4 weeks, okay, and rerun that generic set of filters, and now I've increased my set of stocks that meet that minimum criteria set to 24 stocks. Okay, so there they are. You see a lot of familiar names because it is looking at stocks that have weeklies that trade over $20, that trade over 2 million shares of daily volume. So you recognize all these names. Okay, and all right. So if I want to, I can do one better. I can go out 6 weeks and get right into the earnings season. Get right into the earnings season. Submit that, and now we got 139 all of a sudden. Okay, we just added 2 more weeks because now we got into the heart of the earnings season, right? And now we got lots of candidates, right? Lots of candidates that meet that simple set of criteria. In fact, we've got 6 pages of candidates here, okay, sorted by their earnings date. So there you go. Now let's filter based on this section, tracking price change 1 day after earnings. Let's filter. Let's start with EVR. No, let's go before we get into that. Let's just go up here. There is one more criteria up here that we can filter by, and that's EVR, earnings volatility rating. So earnings volatility rating, as most of you know, is a indicator, if you will, or it's a measure of how volatile a stock is upon its earnings announcement. And it is a 0 to 10 rating, and I consider anything a 4 or over to be a high EVR. In other words, that's the kind of stock that has the potential to move big on earnings. Look at Rite Aid. Rite Aid is now this pop up is great, except that it's annoying too. You can move it up and out of your way, okay? And then as you hover over different symbols, it updates with whatever symbol you're hovering over. And it gives you some specific information on that symbol, okay? So there's Micron currently sporting an EVR of 2.7, and it gives you the last 4 earnings events. What was the expected 1 day move? Okay, I believe that's based on the monthly options. I believe that's a monthly option. I believe that's based on the monthlies. The implied move 1 day, if you will. And what was the actual high move and what was the move at the close of that day? So there's some valuable information here, including some other statistics. So what we can do is, if we want to see something, I'm going to go back to RAD here, okay? And as you can see, all I got to do is hover my mouse over any symbol, and then this pop-up changes to that symbol. But if I want even more information than what this is just a glimpse. If I want even more information, what I can do is right-click on that symbol and open it up in a new tab, and that's going to take me to Rite Aid's stock-specific pages. Now the black bar turns into all the different stock-specific pages, implied move weekly, implied move monthly, and post-earnings page, where I can get all this information. But it takes me, by right-clicking on that, it takes me by default to the earnings history page, which if you scroll down past this table that tells you about all the most recent earnings, and there's 8 pages, by the way, of earnings events and information here. If you scroll down, it's going to show you that Rite Aid was not always a high EVR stock of 8, 9, It's only this last year or year and a half that this thing has gone crazy. It used to be way down here not too long ago at a 1.7. Okay, so things have changed. Okay, things do change, right? And the stock market is changing all the time, and the EVR changes every quarter. And it's worthwhile to get a feel for stocks that were out of play a few short years ago and didn't really do much on earnings that are now, all of a sudden sporting very high EVR of 8.4. Now, what causes a stock to get an EVR of 8.4? Right here, big moves, 1 day moves right here. One trading day after the earnings event, moves of 9%, 31%, down 18%, up 29%, down 26%, up 50% in 1 day. This is kind of activity will bring your EVR up in a hurry. Okay? All right, so EVR is something that's home to optionslam.com. In fact, I will take full credit for developing that formula that actually measures EVR. All right, so EVR, really important. We can do that. We can go, while I'm here, we can just jump over to post earnings page for the new users so that you can see that we're still on RAD here, because I'm using the black bar. I'm going to stay with Rite Aid Corporation with all of these different tabs, okay? But this will tell me not only the 1 day move, okay? And by the way, this is the closing move of that 1 day, the 1 day closing move. But not just the 1 day move, but what happened after 3 days? What happened after 5 days? What happened after 8, 13, 21 days? What happened 2 months out? Etc. Okay? So there's that. Let's jump back to our screener here. And when we filter by adding the EVR, and we look for stocks that move big, let's look at only stocks that have an EVR of what I consider a high EVR. A 4 or over, I consider to be a high EVR. These are stocks that have the potential to move big on earnings. So if I go a minimum of 4 and no maximum, okay, 4 to NA, in other words, all the way up to 10. Okay, I could put in a 10 here, it wouldn't matter, or I just put in NA. From 4 above 4 and refilter, I'm going to take my 139 stocks when I submit that down to only 11. Only 11 out of those 139 stocks have an EVR of over 4. Most stocks have EVRs of 3, like 1.5 to 3 to 3. 1.5 to 2.5 is really common. The great majority, obviously, but I just ran a test for you. Over 4, less than what? 7%? 11 out of 139. I'm not going to do the math, but whatever. Guess ballparking it at 7%. Have an EVR over 9. So let's see who they are. Plug, RAD. Okay, again, I can hover my mouse and get that information of, in case I don't know. I happen to know all these companies. But if you didn't, then that little pop-up is helpful, because then you get the name of the company and some other specific information, etc. There's Harley Davidson. It fits that bill. I didn't know that. That's 4.9. I didn't know Harley was a high flyer. Let's go see that. I'm just interested to see if Harley's always been a high flyer or if it's just like a rad or a recent high flyer. Oh yeah, it's a recent. It's a recent high flyer. Look at that. It was down here at 2.7 for years and years and years, and even lower than that. Here's the lows. Let's see. There's the lowest one I can see. 2.1. I don't know if you can see that little pop-up that goes over there. I don't know if you can see that little pop-up. 2.1, 2.2. But here recently, Harley Davidson in the play for those long straddle players might be interested in this. Now, long straddles, double-edged sword. You want stocks that can move, right? You want stocks that can really move on an earnings event. However, those stocks that can move on an earnings event have a high EVR. That also will translate to have high implied volatility, which translates therefore to high option premium, which means that those are expensive straddles to buy because IV is pumped up, because the market expects a big move. So the market will build that big move into the price of the options. So you're going to pay more for a high EVR straddle. Let's say you compare a stock that's let's do this. Compare a stock that's $100, high EVR, with another stock that's $100, low EVR. The high EVR stock is going to have a high premium. It's going to be an expensive straddle. The low EVR stock is going to be much more affordable, although it will be a more expensive straddle than if it was an earnings event, if it wasn't earnings time, okay? But, okay, so just trying to illustrate a point there. Okay, so that's interesting. Harley Davidson, high EVR of a 4.8, 4.9 now, 4.9 now. All right, interesting stuff. All right, let's see. Let's go back to our screener. Okay, so here we are at the screener. We got high EVR. So let's take that off and let's look at some other ways to screen for stocks that have the potential to move. I'm going to remove that filter. We're going to do these one at a time. Now, I've got another filter here. Let me see. EVR, we did that one. Let's do this one. The last number of earnings release moves where the stock moved over X percent. All right. Okay. Let's try that one. Max one-day move or final one-day move. Well, what this refers to is two simple things, and that is, let's go back over to RAD's earnings history page. And on the earnings history page, we have the price movement within one trading day after the earnings event, okay? So here's the price of the stock before the earnings event. Here's the change at the open the next day after the earnings event, up only 1%. But by the end of that day, it was down 7%. And sometime during that day, the biggest move during that day was down almost 10%, 9.86%. So that's what we're talking about here, is the final move refers to the close of that one day, or the max move refers to the highest percentage-wise away from $19.05, whether it's up or down, is indicated by green or red here, okay? So here the closing move was 17% higher than $17.11 on this earnings event. But the final, the highest move during that day was up over 31%. And then it gave a lot of that gain back and ended up closing still very big move at 17. So that's what that's about. So that's what this filter is exactly. And I can choose either to filter by the max one-day move or the closing move. Personally, I like using the closing move, but there's nothing wrong whatsoever about using the max move. I mean, it's just a personal preference. So I'm going to go ahead and use my personal preference. I'm going to use the closing move. I'm going to say, out of the last, 3 earnings, I want stocks that moved at least 5%. One way or another. I'm just looking for pure volatility. I don't care if it was a move up or down. I want a stock that can move at least 5%. The 3 most recent earnings in a row. It's the only filter I'm changing. I got rid of the EVR filter now. Okay. Now, I wonder if this will do this for me right away. Yeah, it looks like it worked. Let's make sure that it got rid of the EVR. Yep, no EVR. It kept the last 3 earnings 5. Okay, so again, remember, this was 139. It was 139, and when we used EVR, it brought it down to, what was it, 11? I think it was 11. And when we use this filter, now it's going to change depending on, it's going to change depending on what you use here. If you're just looking at the back 1 earnings, 2, 3, or 4, if you're looking for an earnings move, for example, if I move this up to 8% and submit that, now I only got 3 stocks, okay? Now I only got 3 stocks, and RAD isn't even in there. RAD isn't even one of them anymore. And we know RAD is a huge mover. All right, so anyway, that's to illustrate that metric, if you will. Go back to 5, and we got our 12 stocks there. All right, I wish that would stay where I would put it. I like it up there. Okay, let's see. What else do we got? We got a few other things we can screen for here. Where'd my PowerPoint go? There it is. Okay. We just did that one. The last number of ER moves over X%, okay? And then the weekly implied move versus the max 1-day move. What's that all about? Okay, the weekly implied move versus the max 1-day move. So let's get rid of this filter. Let's go back to NA here, clear that filter. This won't work anymore because I cleared it over here, but I'll clear this too just to make sure. Okay, and now we should be back to our 139. Yep, sure enough, we are. Now, we're not interested in this final 1-day direction because that's just whether it was up. It was up only moves or down only moves. This is looking to pick direction. If you're looking for stocks that moved over the last 3 or 4 earnings, only had bullish moves, this is a filter that you could use in conjunction with these filters down here. We should have done that a few weeks ago so that's really not of interest to us in straddles, because with straddles, we're delta neutral. Whether we're a long straddle or a short straddle, we're delta neutral, we're at the money, and so what we're looking for is the weekly implied move. Let's use 3 earnings again. Let's use the last 3 again. Where the implied move, the weekly implied move, now this obviously is only going to work for stocks that do have weeklies, okay, was outside. If I'm looking for a long straddle, right, I want to find stocks where the stock consistently moves beyond the implied move, right? If I want a short straddle, well, then I would look for stocks that consistently move inside the implied move. But since we're talking about long straddles today, we'll look the last 3 earnings for stocks that moved outside the implied move. Now that's sometime during the day. That's the max move, okay? That's the max 1-day move. So let's filter our 139 set and find the subset. Takes us right down to 24 stocks. So there's 24 stocks that moved outside the implied move. Okay, so implied move. Let's go to the implied move page. Oh, let's take hog off and rat off, and let's go to let's see. Let's see. What do I want to illustrate? A couple things. No, let's go. Let's see. I'm surprised rat isn't in here. That's actually the one I wanted to go to. But we can go to hog. Let's right click on that and let's go to hog and let's take a look at. Okay, so when I do that, it takes me by default to the earnings history page. But where I want to go is the implied move weekly or implied move monthly. I could use either, but let's start with the implied move weekly. And so here I want to show you that we have some statistics here, and the statistics assume that a trader bought the straddle and tells you what the straddle cost and what the profit or loss was for the long straddle. So if you shorted the straddle, you can assume that you would have had a 72% loss. If you bought the straddle, you can assume, and the statistics shows you, that you would have had a 72% gain. So what are these statistics? It's February 2nd. So on February 1st, okay, February 1st, assuming that was I don't have the day a week here, February 1st, I can just defer to February 1st, right? Okay, so that's a Monday. Okay, so hog reports Monday before the open. Let me double check. Tuesday, February 2nd, Tuesday before the open. Okay. So this trade was initiated on Monday right at the close, okay? So that's what this says, because this is a before the open earnings event. So the straddle price was exactly $4, okay, for the $40 straddle, and that stock moved big, as much as 22%. But by the end of the day, it was only up. This is straddle prices here. This is not the movement of the stock. I don't have the closing move on this page. I'm going to have to go back to what the closing move was by going back to earnings history page. I'm going to do that by opening that in another tab. I'm trying to figure out a way to provide all this information on less pages. But let's see. February 2nd, that was this move here. Max move was 22% down, but the close move was down 17%. That translates, let's jump back to the implied move page right here. That translates to a 72% win, with the stock down 17% from the pre-earnings close, okay? Here's a almost 100% gainer. So you can see right here, these are statistics that you can see, well, if I would have played the long straddle, how would I have done? You don't have to do a whole lot more research than right here. It's this gives you the one-day result. But what would have happened in this worst case scenario of down 40%, down 56%, another down 56%, that's the 1 day P&L. Okay, that's the 1 day P&L. But if you, just because the 1 day P&L is a loser doesn't mean that this trade necessarily ends up being a loser, right? Let's see. I see we're already running out of time here. So I knew I wasn't going to get through everything today, that's for sure. But I wanted to get further than I've gotten. Let's see what else that was a filter here. We were talking about filters. I think I got through them all. Yeah, I got through them all. Okay, so we got through all the filters. Let's jump back to the PowerPoint and let's see where else we need to go. Okay, so we got through all the filters. Those are the different ways you can use the stock screener to filter for straddles. Either whether if we're talking about long straddles, but you can use those same filters in a very similar way to filter for short straddles, or more popular is short strangles, because the short strangles give you a wider range within which to win. Slightly higher probability. All right, let's see what else we got. So managing risks. Okay, so this is where we're going to have to. I just won't have enough time to get into a lot of this today. Let's see how far we can go. I'm going to introduce you today to a new tool called OptionNet Explorer to illustrate some trades. I can go back in time and illustrate trades with adjustments a lot easier than I can with Thinkorswim. So managing risk. So when you have a long straddle on, okay, and the next day, like that example we just saw, up 78% in one day, it makes a lot of sense to close that trade. You know, it just makes sense to close that trade. It's kind of a gift from the options gods, right? I'm not sure that I want to do anything more, but if I'm only modestly profitable and I think the trade has legs and I think there's room, I want to illustrate how you can enhance the profit potential and at the same time reduce the amount of risk you have in the trade. And I'm going to use that new tool, OptionNet Explorer, to do that. Managing risk, locking in profits, minimizing and reducing risk, gamma scalping. We won't have time for that today. Next class, we'll get into gamma scalping. So the winning straddle. The obvious thing to do with a winning straddle is close the winning side. In other words, one side of a straddle is making money, the other side's losing money. If I bought a call and a put and now I've got a trade that's profitable, only one of those options is profitable. The other one lost money. The point is that the one that made money made enough money to absorb the losses of the losing side. So the obvious thing to do is close the winning side. And it's possible that stock turns around and goes the other way, and you still have that other option, okay, that could also turn into become a winner, or at least gain some more value than what it has on the very first day that the trade becomes profitable. Next option is just close the entire trade, close the winning side and the losing side, because the losing side has some value. It didn't lose all its value. So those are the two obvious things to do, right? But what I'd like to show you is some other things that you can do to enhance the potential profits of the trade, or at least the most probable likelihood of profits of a trade. Okay. Or even in a losing trade. Well, let's see. I think I probably have a losing straddle slide. Let me see if I do. Well, I think I do. Roll the untested out of the money side closer. Okay, this is another strategy that you can do. Okay, rather than talk about these. Okay, I think I spelled that wrong. Shouldn't that be an O? All right, I don't think. All right, so I think what I want to do now is go to OptionNet Explorer. So let me give you a quick overview. We'll just go a few minutes over here today because I don't see getting through too many examples here with at this late time frame. Let's go to red. Let's go to a trade date of 9/23/20. So, and then I'll illustrate to you how this thing works. So 9/23/20. We're in 2020, so we got to go forward to August 23rd. And RAD. All right, there I have a trade. It's September 23rd. Red reports, let me see. I got to go over my other computer so I don't flip screens on you too much here. Red reports before the open. Let's see, 9/23 is a Wednesday, so they reported 9/24 before the open. Okay, so the next morning's earnings event, September 24th, 2020. Okay, just this past fall. All right, so you see the at the money. Okay, so here with this software, this is called OptionNet Explorer. Okay, and it's called ONE for short, ONE for short, OptionNet Explorer. And what we have here is an options chain. Here's the strikes, here's the calls, and here's the puts. Okay, the at the money is highlighted in red. Okay, and you can see I've already got a modeled in. I've got a long, a 1350 call, long a 1350 put. Here's the risk graph of the straddle. Here's where price is, that little red bouncing ball right there. And all these green plots are the price of that straddle at other times earlier during that day. I'm at 3:30 Eastern time here, a half an hour before the market closes, when I initiated this trade. Okay, so there's the background, and you got the options chain and the risk graph all in one screen. I kind of like that. We can actually jump over to the price chart and see that the break evens of this straddle are plotted on here around where price on a price chart. So these two horizontal lines are the break evens of this particular position, which is a long straddle, with price right here on September 23rd, right in the middle between the two break evens, as you would expect. Now, let's see, what options are we in here? The September 25th weeklies, which expire in 2 days. Okay, so this is going to be not much you can do. So let's take a look. Let's take a look at the value. This option was about $1. See it, 96 cents, midpoint price, about $1. We'll call it $1. And this one was just over $1, so we'll call it $2, right? And here's the actual cost, $201. Okay, so for one contract, it was $201 to buy that straddle. Guess what? There's only Thursday and Friday, and those options expire. So this trade, this stock needs to move, because if it doesn't, there's not much you can do. That's what I was talking about earlier in the PowerPoint slide presentation, that short dated options leave you very little opportunity to adjust I guess it's most important when you have a trade that isn't doing well, is when you want to make adjustments. So if this trade either needs to make it or break it out of the box here. So let's go forward today and see what happens. We know that we got $2 invested in this trade. Go forward today, and bam, that stock moved. It was here at the 1950. Or excuse me, at the 1350, right? At the 1350, it was right here in the middle at the 1350, and that stock moved, and it moved beyond the break-even point, and it's up here with a $53 profit, representing about a 26% profit against risk. Okay, $53, 26% of $201. Okay, so that's how that math works. All right, and but here's the thing. There's not much I can do. If I wanted to enhance this by maybe looking to, like, if the stock moved this far on day one, is it going to move that far again on day two, way up to here? I doubt it. Here's one standard deviation right here at 1050. One standard deviation is at 1050. So I would consider selling a 1050 put. Okay, I come over here and look to sell the 1050 put, but the problem is there's no premium there. There's only 7 cents. So that's what I mean. Option premium got decimated in these short dated options. Okay, so let's go to another trade. Let's go to this using the front monthlies. Okay, and let's go back to the 23rd, and now we're on a different trade, not using those front weeklies. In this trade, I'm using these options that don't expire until October 16th, 23 days from the trade date. Okay, now $304. Well, geez, I got a trade. Instead of spending $200 for a trade that only has 2 days of life and potential, I can just spend another extra $100 and get 24 days of life to my trade and potential for me to either enhance the winning profitability potential of that straddle, or in the case of a losing trade, reduce the amount of risk that's involved, thereby minimizing the maximum loss potential in the case of a stock that doesn't move sufficiently enough to become profitable. Okay, we already know this one did move enough on day one. So but now we're doing the same stock, same strikes, 1350, but further out in time. Let's go to day one. Okay, we remember the 1 day trade, the 1 week trade was profitable right away. We do this trade, not so much, because the stock didn't move far enough to absorb the additional premium. So there's what I mean when I say there's a double-edged sword in all of these decisions in trading options, and it becomes very apparent in the long straddle. So what can I do now? Well, here I can make some adjustments. I can, as a trader, I can go with the thought process that, well, the initial reaction was a substantial move down in price. If I may go with the flow, trade the trend kind of a mentality, I'm going to maybe place my bets that this thing has more room to move to the downside. I could be right, I could be wrong. I honestly don't even know. We could cheat and go to optionslam.com to the post earnings page and learn exactly what did happen. But let's just play this out. So now one standard deviation isn't just at 10 like it was with the short dated options, but it's all the way down here to 8.5 to one standard deviation. That's represented by the shaded areas. So I could look to sell. Now, even at the 10, if you'll remember on the previous trade, there was only 7 cents of premium to be had there. But if I go down here to one standard deviation out and look to sell the 9, for example, the 9 at one standard deviation out, see, I'm long this 13.5, and it's making more money than my 13.5 call is losing, okay? Or no, it's got me to break even. In this example, it's got me to break even. So I'm making enough money to be, I'm down $4. Okay, I'm going to call that break even. All right. So what I can do to enhance now, earnings event is out. The earnings announcement has happened. The initial reaction, traders have had a whole day to trade this now. It's the end of the first day of trading post earnings event. It's Thursday at 3:30 in the afternoon. Okay. The whole day has gone by, and I can back this up an hour at a time or 10 minutes at a time and see what all happened here. But here we are at the end of the first day. And there was an opportunity to capture some profit during the day. There were some opportunities to above break even, but let's leave that aside. At this point, I'm thinking, I don't think this thing has huge legs to move, way down, but conservatively, it could move down one standard deviation. So why not sell and bring in some premium and sell that 9 put? And we can model that up simply by putting a -1 here and turning this into a bearish put vertical spread. I already own the 1350. So if I sell the 9, now I'll be long the 1350, short the 9. That gives me an opportunity to make the profit between those two, minus the debit that I have invested. But in this case, what I'm going to do here is I'm going to reduce the amount of debit because I'm going to collect 25 cents for that. Okay. If I want to collect more money, I can go a little closer. Okay. But the closer I go, the more money I collect, the more risk I remove, but the more I limit my potential for profits. And when I hit the enter key, you can see now I've capped my profits. So what this software does is it shows me I've reduced my risk. You see, I was down here able possibly losing $300. Now I'm only possibly losing about $260 or $70, somewhere in there, because I collected 37 cents for that. Okay, so I've reduced my overall maximum amount of risk, but I've also capped my gains. Okay, but this is the kind of a adjustment that just makes sense to me because the big part of the move is probably over. Can this thing have legs and it can go down and down and down all the way to 8 and 7 and 6? Yes, possible, but the probabilities are not there for me. Okay, the probabilities of those things happening are not there. So this is one way to enhance the trade. Okay, we're over time here. I've got lots of other examples to illustrate to you, other methods to lock in profits, other methods to reduce risk, other adjustments to make for losing trades and winning trades. We're going to have to save those for our next meeting. We'll see you next time. And I see there are a couple questions in the room, but we're over time here. Please bring your questions to the next session. We're already over time, and I need to keep this contained. So thanks everybody for being here. Goodbye for now, and good trading.